Good afternoon, everyone. Thanks for joining us for another one of our Compliance Mondays as we prepare ourselves to enter into 2014 and get knowledgeable on all the new compliance changes. My name is Gary Martell. I'm one of the owners of Mount West Financial. I'm joined today by
Ann Savage, the Vice President of Legal and Compliance.
We're going to work together today to cover a couple topics that will, again, get you hopefully prepared as we move closer and closer to our January 1st kickoff date. So with that, we're going to talk about the two H's, HOEPA and HPML.
So the focus of today's program is how to identify a HOEPA loan or a high-cost loan, also called a Section 32 loan. It has a lot of names, versus a higher-priced mortgage loan. Both of these loan types are out of out of Truth in Lending, and then that's where the sections come from. So Section 32 of Truth in Lending is the high-cost section, and Section 35 is the higher-priced mortgage loan section. We believe that Mount West is likely to continue to originate FHA higher-priced mortgage loans, and we are not yet sure about the high-priced HOEPA loans.
Yeah, one of the things I think most of us realized earlier this year when HUD changed their MIP, a lot of FHA loans fell into HPMLs, which didn't really affect things because you'll see there's some requirements on HPMLs. We're going to go through that today. And most FHA loans, if not all of them, already met those requirements. The only change is, like on the FHA Streamline, there had to be an ability to repay. So you saw most lenders, if not all of us, move over to make sure that we couldn't do an FHA Streamline without documenting the borrower's ability to repay.
All right, let's start with HOEPA. So that's a high-cost mortgage loan. It's under Truth in Lending and Regulation Z. Just a little bit of history. It was first enacted in 1994 with an amendment to Truth in Lending. It mostly applies to consumers' principal dwellings, but there's a significant number of provisions that also, in other parts of Truth in Lending, that apply only to a dwelling. It doesn't have to be a consumer's principal dwelling, but for purposes of HOEPA, it is consumers' principal dwellings only. In 2010, Dodd Frank expanded the scope of HOEPA to apply to purchase money mortgages and HELOCS for open-end loans. Those statutory changes aren't going into effect particularly until the rules were changed. So this is just a little bit of background on that section. Go to the next one. For our purposes today, it's important to note that the changes for HOEPA and higher-priced mortgage loans go into effect on January 10th. So a lot of the other provisions, most of the other provisions that are changing are January 1, most particularly ECOA for accounting reasons. This one is January 10th, and some other provisions are on the 18th. What's interesting here is on January 1, the CFPB and previously the Fed publishes the price adjustment. So we're going to have 8 days under one rule in January 2014, and then, or 9 days, and then we'll have the new rules after that. Some of the things that changed for HOEPA is the change in the rate threshold calculation. There's also changes in the points and fees thresholds, new prepayment penalty test, and counseling requirements. The rate test is really you're taking the APR on the loan and comparing it to the APOR. The APOR is the average prime offer rate for Freddie Mac loans, and it's published weekly on the FFIEC website. They have two different tables there that you can look at, and there's one for fixed versus ARM loans, and then it's based on term. One thing that's important to know is that the test is based on the rate the date was locked, the APOR, the date the rate was locked. So if it's not locked, you have to use a proxy like the application date.
And again, remember as we go through this that the APOR only changes and is republicized every Monday. And so any loans that are locked for the next 5 days would be referred back to that Monday's date for the APOR versus the APR test.
Right. There's a couple of just other little things to be aware of. On a HELOC, if you don't have a definite term for the loan, you use a 30-year term, and that's in the regulation. And if it's an ARM, you use the greater of the introductory rate or the fully indexed rate, whichever is greater.
One of the other things, I think all of us know that there's technology out there, some really good software that helps with these tests, so that once you've talked to an applicant and you start putting your fee worksheet together, you have software at your fingertips that you can run and check these tests out. They just have to be maintained, especially with the APORs. As long as that's current, it would be, most softwares can test against that.
Right, and that's also why it's helpful to know, though, what goes into these tests and how they're calculated, because then you can more easily determine what you need to change if you have a problem with the loan. Okay, so the tests for HOEPA loans vary by loan amount for the interest rate. So if the loan amount is under $20,000, or I'm sorry, the points and fees test, if the points and fees exceed 8%, it would be considered a high-cost loan under truth in lending. For loans $20,000 and more, it's a 5% test. These dollar figures, the $20,000, can be adjusted annually by the CFPB and would be published in the Federal Register. For closed-end loans, pretty much you're going to be using the same calculation method for points and fees as you do for QM. For HELOCs, it's just a little bit different. You have to consider participation fees and fees charged to draw on your HELOC. There's usually an initial draw fee. So those would be added. I think where it's a little unclear how you would calculate it by assuming more than one draw, but that's an issue for the regulators to hopefully clarify for us. For now, you just know you have to do at least one. Okay, so for the HOEPA points and fees test, it's important to know that the finance charge calculation is not the same as points and fees. They're very similar, but they're not exactly the same. So for HOEPA, for the points and fees part of the test, you're taking basically all the finance charges. You need to include loan level price adjustments, which I think Gary would want to say something about that when we're done here. Also the LL comp attributable to the transaction, most credit insurance, if it's paid at consummation or finance. There are some exclusions if it's payable solely to the consumer, but probably not really worth getting into too much. And then there's the prepayment penalty. So the maximum possible prepayment penalty under the new loan would have to be included in the points and fees calculation. And if you are refinancing your own loan or an affiliate's loan, and there's a prepayment penalty that would accrue, that would also have to be included. So that can really grow your points and fees percentage quite quickly and cause it to fall into the high cost loan category.
Now, one of the things, like Ann had alluded to, the LO comp part of this is pretty straightforward. It's comp that's paid either by the consumer or by the lender to a broker, or by the consumer directly to a mortgage broker. The loan level price adjustments, as we know today, there's several of them that can affect a loan depending on the attributes of that loan. I think a lot of lenders are looking at, do they leave those LLPAs out as a fee, like a point and cost, or do they wrap it up in the interest rate where we have 1.5% above the APOR to work with. So I think you'll see the lending industry kind of jostle with that a little bit and see which best fits for not only consumer, but for the business partners at large. Remember, there's some items that you're going to exclude as well, and the interest time price differential. So part of that is depending on when you're closing during the month, and the mortgage insurance, the FHA premium, and that's where private mortgage insurance falls into play. There's some private mortgage insurance available today that's borrower paid, that's non-refundable. That would be included. If it's refundable, it would not be included. And again, you're going to get some more finite regulations, but just know that for the most part, FHA MIP is not included, but if you have PMI, some of it may be included for the points and fees test. And then also bona fide third-party fees that are for an affiliate. would be included, and if it's not an affiliate, it would not be included. And this is when it doesn't equal the finance charge. And what specifically is if you have a closing fee for an escrow company, you would normally include that in your APR fees, but you would not include that in the point and fee test here. So that's where some of this changes a bit. And we've talked about the bona fide discount points. So bona fide discount points, and I think most of us realize that a borrower only is to pay a bona fide discount point and truly if they get a reduction in the interest rate for it. So that being said, the feds come out and said you will not charge up to 2% as long as you can provide proof that that 2% that was paid in discount points actually went to a reduction in the rate. Now, they're still out there talking about how to be able to prove that, but in most cases, they're going to be looking for a rate that we have that all lenders post that is close to par for that same rate, and then find out within 2 discount points if it's truly reduction. How we're going to be able to provide that is still totally unknown, except they're going to be looking at how the market treats that. And they rely, in some cases, back to Fannie and Freddie and how that works.
Just to add one other thing. In this slide, we're talking about if it's secured by personal property, use a different rate than the APOR. But what we mean by personal property, it's still got to be a dwelling, so a manufactured home, RV, anything like that.
Gotcha. So again, a bona fide is if it truly reduces the consumer's interest rate by an amount that reflects established industry practices, such as secondary mortgage market norms. And again, at this point in time, the CFPB has come out and given us things that talk about looking at how Fannie and Freddie do their day-to-day pricing as an example of how it's how they're going to decide whether it's truly bona fide or not.
And this statement in bold below is what the CFPB has stated, that they're going to be announcing some sort of market for mortgage-backed securities we might be able to use. But it's, as Gary said, they haven't really made it 100% clear what they're going to do and how much guidance they're really going to give.
And I think, as most of us know, in this industry, the amount that a discount point reduces the rate could vary based off coupon, interest rate, loan program, securities type. So there's a lot of factors, and I think the CFPB is currently struggling with how to make a norm out of a fluctuating market.
So this is a new piece to the HOEPA test. So if you have a prepayment penalty that is more than 36 months in length or more than 2% of the amount that is prepaid, it doesn't matter what the APR is. It has a prepayment penalty that violates these provisions. It's now considered a high-cost mortgage. Let's see. There's a number of restrictions. So now you've determined it's a high-cost test. Now what do you do? Well, right now we wouldn't do anything because we wouldn't originate it, right, Gary? But we're not sure. But some of the other things, we're not going to go in a great deal of depth, but there are disclosure requirements, restrictions on transaction terms, fee restrictions, ability to repay rules, and pre-loan counseling rules.
So we're going to talk a little bit more about high-price mortgage loans, HPMLs.
They like to make all of the different tests and names sound the same, so that it's a tongue twister. So for the higher-priced mortgage loan test, first of all, it only applies to closed-end consumer transactions secured by the consumer's principal dwelling, and then again we have an APOR test. In this case, for this test, you're looking for a first lien with a loan amount that doesn't exceed the amount eligible for purchase by Freddie Mac. You take the APR and you add 1.5%, and if it exceeds the APR, it's a higher price mortgage. For the other version of the test for first lien, it's very similar, except for the loan amount has to be more than the amount eligible for purchase by Freddie Mac, and then you have the 2.5%.
We've had people ask, well, why would be the difference? And again, I think that at least the CFPB understands how the market moves. You know, the cost, if you can keep a consumer in what we call conforming loan amounts, and agency loan amounts, that's the least expensive form of financing. And since the test is off of that, once you get into the jumbo or non-conforming loans, as we all know, the interest rates go up on those loans automatically. So you're still comparing them back to the APOR, which, as you would think, would create that price differential.
I mean, I think that makes sense. And, I think, they used to have provisions about a jumbo loan, and then you had kind of a blank space in the middle there where you had the high balance. And so this is getting rid of it, just making it a little more clear, a little easier in some ways.
Yep.
If it's a junior lien, the test is basically the same, except you're taking the APR plus 3.5%, comparing that against the APR to determine if it's a higher price loan. The Dodd Frank Act and the CFPB require escrow accounts for HPML loans in certain circumstances. Well, in almost all circumstances. It's already in effect. It went into effect in June of 2013. If you have any questions, you're welcome to ask them. There are also prepayment limitations, repayment ability requirements, and some new disclosures. I think one thing to note is there are already existing repayment ability and prepayment limitation requirements for higher price mortgage loans, but they will sunset on January 9, 2014, and they are going to be replaced with limitations around QM.
And we're going to be discussing QM much more in detail in the next couple of weeks as we get closer to this wonderful trigger dates of January 1st, 10th, and 18th.
It's always good to know when you actually have to comply. All right, so for the higher price mortgage loans, there's some appraisal requirements as well. And there's a bit of an overlap. I think that can cause some confusion between ECOA Reg B appraisal requirements and the Reg Z higher price mortgage loan requirements. For higher price mortgage loan, you have to provide a copy of the appraisal. And you have to deliver it at least 3 days prior to closing, and the consumer can't waive that. Under ECOA, you have to provide, and this is not, the ECOA requirement is not related to it being a higher price mortgage loan in particular. So you have to provide a copy of the appraisal or other written valuation that we used in making our credit decision. There's also some timing requirements, 3 business days before closing or promptly upon completion, whichever is earlier. They had given, they being the CFPB, had given some examples in their commentary about what is promptly upon completion. So it's some clarity, but essentially part of it you can maybe extend that time period with policies and procedures, but it becomes unreasonable. I would say essentially at around 10 days. That would be that's kind of a guess based on some of the examples they give. So take that with a grain of salt. This is not legal advice, et cetera, and so forth. And ECOA applies to creditors, which my reading would indicate it applies to brokers as well.
So again, the reason why we bring this ECOA, and we're going to dive a little deeper into that in about 4 weeks, but there is 2 different regulations that require us to provide a copy of the valuation to the consumer, one under Reg B and one under Reg Z. Reg Z is what we're talking about today, but there's an overlapping one that we feel probably is a little more in-depth and has a few more requirements that will supersede or go in conjunction with this. Just know going forward, the borrower has to receive a copy of the appraisal and or valuation, and they have to receive it not less than 3 days before closing, or as Ann had said, promptly to the borrowers upon completion, which should be within 24, 48 hours, 72 hours, and not more than a week or so under most circumstances.
I would agree. One other thing I'm just going to mention there is I boldly put in Mountain West's position on that without clearing it with Gary, but as a general matter, even if the consumer is allowed to waive a right, we would not allow a consumer to waive that right. It just creates a huge amount of legal liability and litigation. For higher price mortgage loans that are first lien, there is also an additional disclosure requirement which goes to appraisals and doesn't exactly match any of the requirements. So the disclosure says that we may order an appraisal to determine the property's value and charge you for this appraisal. We'll give you a copy of any appraisal, even if your loan does not close. You can pay for an additional appraisal of your own for your own use at your own cost. Essentially, we have to provide a copy of the appraisal. I don't know why we're saying we don't have to if it doesn't close. Depends on which law you're looking at, I guess. But also, as a best practice, we would recommend using the word adding the word promptly, and then it makes it more congruent to both of the regulations when you put it together.
Yep.
Okay, so right now, most ECOA appraisal disclosures are done separately, and that is how we will no doubt be rolling this out initially. This should eventually be rolled into the final combined TIL and RESPA disclosure, but we don't have a final combined disclosure, so for now it will be separate as it is now. Can't charge for a copy of the appraisal, can't raise their rate or mark up any fees to cover the cost of mailing. We have the 3 days, has to be delivered within 3 days of closing or more. Business days matter whether you're open for Saturdays or not. And then this is an interesting one, particularly in light of what the disclosure says. So if the loan doesn't close, you have to deliver the appraisal within 30 days after the determination that was a higher price mortgage loan. And of course, the ECOA requirements still apply. There's also this concept of a safe harbor for appraisals, which is new to me. One of the things, of course, you have to hire an appraiser who is properly licensed and is following all the industry standards. You have to, if you have actual knowledge that they have acted in some way contrary to the standards or their licensing or how they've completed their appraisal, you don't have the safe harbor. You also have, and I'm not exactly sure what the safe harbor means. It just says it's a safe harbor, which implies there isn't a safe harbor. So I think that it's just more litigation risk and maybe regulatory risk at this point. And then if you have a flip, whether it's a different rule for up to 90 days or between 91 and 180 days, you have to get the second appraisal. And you can't charge the second appraisal to the borrower. There are some exceptions, like in the case of an inheritance or a divorce. You may not have to get a second appraisal. But then you have to do an analysis of the second appraisal and document that to the file.
So just to sum up a little bit here, we want to make sure that, again, you folks are aware that we will be doing 30 minutes every Monday. We will post these so you can come back to them if you miss one as we go along. We're building on some basic concepts, and we'll continue to build on those until we get closer and dive into the actual screenshots and policies and procedures that will be put in place. But just know that we're covering 2 regulations that are both out there now with slight changes going Monday, that would be a little soon, that are going to take place January 10th. And again, we have HPMLs out there now, high-price mortgage loans. We do them as an industry. We make sure that there is the ability to repay, that they have a points and fees test. And most lenders today, although not all, do not do HOEPA loans, the Section 32, but they are available and they can be done, and I believe they will be done in the future. So if you have more questions or comments from today's presentation, feel free to email Ann at her email address on the screen, and she'll reply promptly. Next week, we will dive into another version of our Compliance Mondays. And as you see, there's other webinars and workshops that we have going. But next week, we plan on starting down the path of loan officer compensation, and we're going to do 2, one next Monday and then one following up in November. We want to thank you for taking 30 minutes with us today. We appreciate your time. We know how busy you are. And we hope that together we can make sure our compliance is rolled out in a way that not only affects and protects the consumers, but is also in compliance with the regulators' wishes.
Thank you.
Have a great day.